The S&P 500 is up 9% this year. The Nasdaq is up over 12%, and yet my portfolio is down 7%. If you look at your own brokerage account right now, there is a very good chance you are lagging behind the market too. Mentally, this is one of the hardest things to deal with as an investor. You feel like you are doing something wrong, while everyone else is getting rich. But today I'm going to show you exactly why we are underperforming, why some of the greatest investors in the world are also bleeding right now, and why this is actually completely normal. Welcome back to Moneyjourney. I want to be completely transparent with you guys. This year has been brutal for fundamental investors. When the headline news says the market is roaring, but your personal net worth is shrinking, it makes you want to abandon your strategy and just chase what's working. But before you hit the sell button, we need to look under the hood of this market, because the headline numbers are lying to you. Let's look at the scoreboard for the first half of 2026. If you just glance at the headline, you'll think everyone is getting incredibly rich. The S&P 500 is up roughly 9% year to date, and the tech-heavy Nasdaq is up an incredible 12%. But remember what I said about the headlines lying to you? Let's pull back the curtain and look at the actually 13F filings and estimate mid-year performance of some of the greatest super investors in the world. If you look at the estimated numbers based on their true starting portfolios entering this year, the story changes completely. Chris Owen and David Tepper are doing decently, around 8 to 12%, but that is almost entirely because their portfolios are heavily concentrated in the exact mega cap tech and semiconductor stocks driving the AI bubble. But look at the fundamentals and value, guys. Warren Buffett is practically flat, up just 0.5% as he sits on a historical massive pile of cash, refusing to pay these valuations. Ray Dalio's macro strategies down around 2% as they try to navigate sticky inflation. And then there is Dev Kantazarya, one of the absolute best quality focus investors out there. Entering 2026, he had roughly 30% of his portfolio in a single high-quality software company, Fair Isaac Corp. Because FICO has dropped nearly 30% this year, his fund is facing a massive drag. Based on those starting weights, he is estimated to be down around 7% right now. These are billionaires with armies of analysts and billions in assets under management, holding some of the highest quality business on earth, and even they are bleeding right alongside us. If you are sitting there feeling stupid because you aren't beating the Nasdaq or the S&P 500 index, take a deep breath. You are in elite company. In fact, Dev Kantazarya's situation mirrors exact my experience this year. Just like his fund is being dragged down 7% because a single high conviction position dropped 30%, my portfolio is facing the same exact mathematical headwind. Which brings me to my confession. I am also down exactly 7% year to date. But for me, the anchor isn't a US software company like FICO. My anchor is Chinese equities, and specifically Alibaba. Baba had a phenomenal run in 2025, and it's probably the result why I have such an overperformance last year. But 2026 has been a totally different story. The stock has dropped roughly 36% since the start of the year, dragging my entire portfolio down with it. But it is where you have to separate your emotions from the data. Like Kantazarya with FICO, I'm not selling my highest conviction play just because the market is ignoring it. In fact, I'm starting to get incredibly interested again. Chinese stocks are starting to look as attractive as they did back in the panic of 2022. The fundamentals are completely disconnected from the stock price. And even when I look for the rest of my portfolio, I've never been so optimistic about the companies I own. And that disconnect is happening everywhere. Right now, we are in the middle of 2026, and if you look at the S&P 500's forward P ratio, it has actually compressed from roughly 23x down to 20.4 since January. How is that possible when the index is hitting all-time highs? Because earnings expectations are skyrocketing by 29%. This brings me back to Alibaba. Baba is trading at a forward P of just 10. With a net cash position that makes up nearly 35% of its entire market cap, that is the exact valuation profile we saw during the extreme regulatory panic of late 2022, when the US market is experiencing extreme crowding at 35 and 40 times earnings. A cash generative business at 10 times earnings gives you a massive margin of safety. Because earnings expectations for AI-related companies are increasing so rapidly that they are asking the rest of the market, there is a massive amount of optimism and momentum justifying the index valuation. But beneath the surface, the broader economy is facing huge headwinds. Sticky inflation, higher rates, and supply chain shifts. Investors are terrified of the broad economy, so they are hiding their money in the same 5 AI stocks. This creates a very specific type of market. The indices are at all-time highs, but beneath the surface there are plenty of incredible cash-flowing businesses that are fundamentally undervalued. You just have to know where to look. And that is exactly why I share my analysis on this channel. My goal is to do the heavy lifting so you have access to the best idea and most asymmetric opportunities in the market, even when it feels like everything else is moving against us. Now, to understand exactly how this bizarre market dynamic plays out for the rest of the year, we have to look at how the smartest institutional minds are positioning themselves. JPMorgan just released their highly anticipated mid-year market outlook for 2026, appropriately titled "The Tug of War Continues." This report is absolutely packed with data, and it outlines the exact battlefield where your money is going to fight for the next 6 months. Let's break down the 3 biggest takeaways you need to know. First, let's talk about the headline grabber. JPMorgan has gone remarkably bullish on the index. They just raised their S&P 500 year-end price target an astonishing 7,800 and boosted their 2026 S&P 500 earnings per share estimate to $350. That is a massive 29% increase year over year. But why are they so bullish? It comes back to what they call the US-led AI supercycle. The sheer amount of corporate capital being poured into tech infrastructure is artificially lifting the entire index. However, the report includes a major warning from Dubravko Lakos-Bujas, their head of global market strategy. He points out that because earnings have been so strong back-to-back, the bar is now set incredibly high. It's going to be much harder for this tech giant to surprise to the upside. Plus, there is an extreme crowding in the momentum factor. Translates that from Wall Street speak to plain English, too many people are piling into the exact same trades, and that creates a massive risk for a sudden, sharp reversal. The second core theme is the tug of war itself. On one side, you have a surprisingly resilient consumer and strong labor markets keeping the economy afloat. But on the other side, we are battling a severe energy supply shock. Even though global goods production is holding up, JPMorgan expects global core inflation to remain incredibly sticky, hovering right around 3%. Because of this, they believe the Federal Reserve is going to stay completely on hold for the rest of the year. No rate cuts are coming to save the day. Instead, central banks are going to stay behind the curve. Interestingly, JPMorgan thinks this slow, cautious approach by the Fed actually acts as an anchor that keeps risky assets supported because it prevents a sudden monetary shock to the system. Finally, look at the currency and international markets. JPMorgan is heavily bullish on the US dollar through the end of the year. Why? Because of what they call AI-driven US exceptionalism. As AI becomes a tool for geopolitical leverage, foreign capital is aggressively flooding into US equities, abandoning other developed markets. In fact, JPMorgan is explicitly bearish on the euro, the Japanese yen and the Canadian dollar. Meanwhile, they expect China's growth to moderate to around 4.7% for the year, heavily dragged down by global tariff escalation and geopolitical friction. If JPMorgan is right, the index momentum could carry us to 7,800 by December. But as a fundamental investor, chasing that momentum right now feels like picking up pennies in front of a steamroller. The market is priced for absolute perfection in tech, while completely ignoring the macro headwinds of sticky inflation and geopolitical supply chain shifts. This brings back to my portfolio underperformance and why I'm looking at underdogs like Alibaba again. While the US market is experiencing extreme crowding in a few stocks, international and value sectors have been completely beaten down. If China's growth stabilizes around 4.7% as projected, the massive margin of safety on these out-of-favor companies provides an incredible risk-to-reward ratio compared to buying a stock trading at 40 times forward earnings just because it has AI in the press release. But look, let's be completely honest here. This JPMorgan report is a probable scenario based on current data. It is not a crystal ball. Nobody, not even the chief economist at a $1 trillion bank, can actually predict the future. The report itself explicitly mentions major vulnerabilities. A sudden escalation in the Middle East could send oil skyrocketing well past their $78 target. A sharp, hawkish pivot from the Fed could rush equity multiples overnight, and escalating trade wars could severely damage export-heavy economies like China. The market path is never linear. As investors, our job isn't to guess the future perfectly. It's to manage risk and prepare for multiple outcomes. Right now, the crowd is betting entirely on one outcome: infinite AI growth. I choose to remain cautious, hold onto my high conviction value plays, and embrace the short-term underperformance because I know the macroeconomic tides always turn eventually. So, if you are lagging the market right now, here is your 3-step protocol for the rest of 2026. Step 1. Check your thesis, not your stock price. If a company's fundamentals, earnings growth and cash flows are intact, the stock price drop is a liquidity issue, not a business failure. Step 2. Resist index FOMO. Do not sell your undervalued value plays just to buy the top of a crowded AI momentum trade at all-time highs. Step 3. Hunt for asynchronous setups. Look for high-quality, out-of-favor companies outside the US technology sector that have a high margin of safety. That is where the next leg of wealth creation will happen. What do you think about JPMorgan's 7,800 target? Are they way too optimistic, or is this AI bull market just getting started? Let me know your thoughts in the comments below. If you found this data breakdown valuable, do me a huge favor. Smash that like button, subscribe to the channel so you don't miss our next stock deep dive. And remember, protect your capital first. I'll see you guys in the next video.